International trade and investment are vital drivers of the economic growth. With the size and shape of the world economy changing dramatically in the recent years, the traditional patterns of trading and investing have had rapidly evolved alongside it. Trading and investing are considerably different methods. Trading focuses on short-term buying and selling, while investing involves buying and holding securities for an extended period of time. So the following are the types, categories, strategies, and objectives of trade and investment.
Trading, where the trade refers to buying and selling of goods and services for money or money's worth. It involves transfer or exchange of goods and services for money or money's worth. The manufacturers or producer produce the goods, then moves on the wholesaler, then to retailer, and finally to the ultimate consumer. For my explanation about trade, involves cross-border transactions of goods and services between two or more countries. When manufacturers or producers produce the goods services, because in Philippines they invest another company or invest partner, so that they build new business and gets product for other countries to produce goods for their services. After transaction, they sell it on but in Philippines, which is called wholesaler. After wholesaler, the retailer, and finally the consumers, who is buyers. That's all. Thank you.
Types of trade: internal or home or domestic trade. Internal trade is also known as home trade. It is conducted within the political and geographical boundaries of a country. It can be at local level, regional level, or national level. Hence, trade carried on among traders of Delhi, Mumbai, etc. It is called home trade. Internal trade can be further subdivided into two groups. First is wholesale trade and the second is retail trade. Wholesale trade. It involves buying in large quantities from producers or manufacturers and selling in lots to retail for resale to consumers. The wholesaler is a link between manufacturer and retailer. A wholesaler occupies prominent position since retailers both are dependent upon him. Wholesalers act as an intermediary between producers and retailers. Retail trade. It involves buying in small lots from the wholesalers and selling in very small quantities to the consumers for personal use. The retailer is the last link in the chain of distribution. He establishes a link between wholesalers and consumers. These are different types of retailers, small as well as a large. Small-scale retailers includes hawkers, peddlers, general shops, etc. External trade. External trade, also called as foreign trade. It refers to buying and selling between two or more countries. For instance, if Mr. X, who is a trader from Mumbai, sells his goods to Mr. Y, another trader from New York, then it is an example of foreign trade. Export trade. When a trader from home country sells his goods to a trader located in another country, it is called export trade. For example, a trader from India sells his goods to a trader located in China. Import trade. When a trader in home country obtains or purchases goods from a trader located in another country, it is called import trade. For example, a trader from India purchases goods from a trader located in China. Import trade. When goods are imported from one country and then re-exported and after doing some processing, it is called import trade. In brief, it can be also called as re-export of processed imported goods. For example, an Indian trader from India purchases some raw materials or spare parts from a Japanese trader from Japan, then assembles it, convert into finished goods and then re-export to an American trader in USA.
So now let's go ahead in different trading strategy. First is scalping. Scalping is the shortest term trading strategy. Scalp traders only keep position open for a few seconds or minutes. Small intraday price changes are focus of this short-term trading. Because of large numbers of deals completed in each trading session, the goal is to make a lot of quick trades with little profit gains and let profits compound throughout the day. Second is day trading. Day traders, unlike swing and position traders, initiate and leave their positions on the same day, eliminating the possibility of huge overnight changes. They close their trade with a profit or a loss at the conclusion of the day. Because trades are typically held for minutes or hours, enough time to require to analyze the market and monitor positions periodically throughout the day. Day traders, like scalpers, rely on little gains over time to develop profits. The third one is swing trading. Unlike day traders who often maintain position for less than one day, swing traders typically hold position for multiple days, if not weeks, to capture short-term market swings. Traders do not need to sit constantly monitoring charts and their trades throughout the day because positions are kept over time. This makes it a popular trading technique for persons with obligations who want to trade in their spare time. However, it is vital to devote a few hours per day to market analysis. And the last one is position trading. Position traders are interested in a long-term price movement, hoping to benefit as much as possible from large price shifts. As a result, trades typically take weeks, months, or even years to complete. Position traders typically analyze and evaluate market using weekly and monthly price charts, using technical indicators and fundamental analysis to find a suitable entry and exit levels.
Investment definition. An investment is essentially an asset that is created with the invention of allowing money to grow. The wealth created can be used for a variety of objectives such as meeting shortages in income, saving up for retirement, or fulfilling certain specific obligations such as repayment of loans, payment of tuition fees, or purchase of other assets. In other words, to invest means owning an asset or an item with the goal of generating income from the investment or the appreciation of your investment, which is an increase in the value of the asset over the period of time. Examples are bonds, common stock, and preferred stock. It may also involve the purchase of other assets, such as property from which rental payments can be generated.
So there are different types of investment. So first is stocks. Stocks includes shares of ownership of any company and helps you earn dividends in return. Second is bonds. Wondering what is investment meaning in terms of bonds. So bonds means lending your money to an institution or government for which you receive fixed interest at regular intervals and also the face value upon maturity. Third type is mutual funds. These funds are collected from different investors and put in a company's bonds or shares, which are managed by fund managers. On understanding what is investment, meaning and your investment objectives, you may choose equity funds or debt funds depending on your risk capacity. Next is index funds. So an index fund is a type of mutual fund that passively tracks an index rather than paying a manager to pick and choose investments. The benefits of index funds is that they tend to cost less because they don't have an active manager on the payroll. The risk associated with an index fund will depend on the investments within the fund. So the next type is exchange traded funds. ETFs are types of index fund. They track a benchmark index and aim to mirror the index performance. Like index funds, they tend to be cheaper than mutual funds because they are not actively managed. The major difference between index funds and ETFs is how ETFs are purchased. They trade on an exchange like a stock, which means you can buy and sell ETFs throughout the day, and ETF's price will fluctuate throughout the day. So next is options. An option is a contract to buy or sell a stock at a set price by a set date. Options offer flexibility as the contract doesn't actually obligate you to buy or sell the stock. As the name implies, doing so is an option. Most options contracts are for 100 shares of a stock. So the next type is ULIP or Unit Linked Insurance Plans. This is a type of investment that provides both investment and life insurance benefits. A portion of money invested into ULIPs is allocated for investment, meaning in this plan, a part of your premium is invested in different funds and help you earn market-linked returns. So the last type of investment is PPF or Public Provident Fund. So understanding investment meaning of PPF is simple. It is a government-offered savings scheme that invests your funds for a specific period and helps you earn returns on the same.
Categories of investment. So there are three categories of investment: the ownership investments, the lending investments, and the cash equivalents. So the ownership investment, as the name clearly suggests, these are assets that are purchased and owned by the investor. And the example of this kind of investment includes stocks, real estate properties, and bullion. And also funding business is also kind of ownership investment. So the ownership investment entails becoming an owner of a business or a property when you invest in part or in whole. So as an owner, you now share in the risk and the losses of the investment. Typically, as an investor, you both have the same profit and the risk. So the examples, the stock investment. This stock investment, your investment will be visible only after a few years. Next is the real estate, developing real estate properties for sale or for lease, and then bullion. And the next category is the lending investment. When you invest in lending instruments, you're essentially behaving like the bank. Corporate bonds, government bonds, and even savings account are all examples of lending investments. The money you park in savings account is basically a loan that you give the bank. This money is used by the bank to fund the loan it gives out to its customers. So lending investment. So this is the financial product where you lend your money to an individual or organization and in return you gain an income. So this is a creditor and debtor relationship, which means when the borrower can't pay, the creditor have the right to demand payment from the debtor. And the last category is cash equivalents. These are the investments that are highly liquid and can easily be converted into cash. Money market instruments, for instance, are excellent example of cash equivalents. Cash equivalents generally offer low returns, but correspondingly, the risk associated with them is also negligible. So the cash equivalent is basically the total value of cash on hand that includes items that are similar to cash.
Investment objectives. Here are some brief descriptions of terms related to investment objectives. First, income is a preservation of capital with a primary consideration and current income. Second, balance is a diversification of asset classes for an equal blend of income and long-term growth with the primary consideration being current income. Third, growth and income is a balance between capital appreciation and current income with the primary consideration being capital appreciation. Fourth, long-term growth with safety is a long-term capital appreciation with relative safety of principal. Fifth, long-term growth with greater risk is a long-term capital appreciation with greater risk. Sixth, speculation is a maximum total return involving a higher degree of risk through investment in a broad spectrum of securities.